What would you say is the biggest challenge investors run into with the exchanges?
The biggest challenge has been the identification.
If you're thinking about doing a 1031 exchange, you definitely want to check out this episode and hear what Dino says about why she thinks identification is one of the biggest challenges. She's also going to talk about how important it is on the entity you have and what issues that may cause. We're also going to go into reverse exchanges, and she's going to give some tips on how to get started, the best ways to get started with a 1031 exchange. So definitely check out this episode. It's episode number 2 on 1031 exchanges here on the Engel and Volkers South Bay podcast. What would you say is the biggest challenge investors run into with the exchanges?
The biggest challenge has been the identification. The last 2 years have been, let's say, an unprecedented real estate market. There's no doubt about it. As you guys have been busy as real estate professionals, we've been crazy in the 1031 space. Now it's getting more normalized, so the transactions are just more normal, at a more normal pace. But the lack of inventory has been a challenge for most folks that were doing 1031. So to me, if you're considering doing a 1031 and you're getting ready to sell your investment property, I think you need to sit down and figure out, where do I want to buy? What is it I'm looking at? And what do the inventory levels look like in that particular marketplace?
So look at it ahead of time.
I think you should, yeah. If you're fortunate enough, maybe you can find a seller that's willing to accept your offer to wait for your sale to close. There's ways you can do certain around these things, but the ID has been the biggest challenge. Other challenges that we've seen of late is when people are buying new construction. You'll see that more, not so much here, but definitely when they're selling. Say for example, if they sell in the South Bay and they're buying into new development in Florida and Texas, because those have been the hot states for a while.
Yeah.
Okay, they get under contract with the new development. And the developer goes, okay, we should be finished this project in 4 months. So they're trying to time everything. You got 180 days. And we've had exchanges that have absolutely failed because the construction was not finished within the 180 days. And it doesn't matter that there were material shortages. It doesn't matter that there were supply chain issues. It doesn't matter that there were labor issues. Okay. So, so those are some of the challenges that we've seen. So, to me, considering a 1031, even though the market's, is more normal paced, still, I think you still have low inventory levels. You can probably tell me yes or no to that one.
You're right. Yeah, it's still low. I mean, looking to get something that's going to be a problem. New construction, it still takes a long time.
It's still taking a while, yeah.
I didn't even think about how that could play into it. But so they would need to maybe delay their closing on
or get on
selling.
Or if they find something, that new construction they want, and they know they're going to sell something, then maybe you get under contract with the new construction well ahead, and then now you kind of have to time, when am I going to sell my relinquished property?
Right.
Okay. In the market we just left, it was put the property on the market, 15 offers. All right.
Right.
Not the same right
Maybe,
now.
yeah,
a little bit more, longevity before buyers are coming to fruition right now. But
and that's something that they want to talk to their real estate advisor about.
Without question,
get that guidance.
Yes. Because the timing of the market. You're going to look at the property and you're going to go, okay, I think this property is going to probably we'll put it in a contract, we'll list it, we'll probably, given the condition of the property, where it's located, and your client base and know what's going on, you can probably give a good estimation of, timing, when the timing could be to put that property on the market.
Yeah.
So it's all market driven.
A lot of moving parts, right?
Just a few.
Another question I wrote down, which I've heard, and I know a lot of our advisors would get this as well, is the person selling it, the entity, how does that match from one to when they're buying different LLCs or? Right.
Okay. So that's an excellent question, and that's one that really is so critical to the success of an exchange. When you're doing a 1031, the taxpayer's doing the exchange. So who's my taxpayer selling?
Okay.
So I have a taxpayer that's selling, and the same taxpayer needs to be the one purchasing. So when you look at the vesting, because that's what your guys are going to see, right? You're going to look at the vesting and you say, here's the title report, and it shows, Ben and Dino are on title to this property. All right, but is it Ben and Dino? Did Ben and Dino at any point decide to create a partnership? So maybe we did the Ben and Dino LLC,
Right.
but we never bothered to change title. So initially, when we bought the property,
Yeah.
we were holding it as like joint tenants or tenants in common, and we had our each little 50%.
Right,
Okay.
okay.
And we were reporting it separately because you and I are not married. Right. Okay. So we were reporting it separately, but then our tax advisor said, no, why don't you put this into a partnership because there's better tax advantages to doing that.
Okay.
So then we create the LLC. We start now reporting everything on our tax returns under K1s,
Right.
but we never changed the title. Now we go to sell the property.
who's
You're
in
the
that
real
situation?
you're the real
right.
estate agent, right? So
Yeah.
you're going to pull up the title and you're going to go, okay, well, the contract's going to be in the name of Ben and Dino.
Right.
Well, guess what? Ben and Dino's not the taxpayer. So now Ben, the real estate agent, has got the contract under Ben and Dino, but Dino, now the accommodator, is going, well, whoa, wait a second. All right, we've been reporting this as a partnership, so this is not in sync.
Wow.
Who's my taxpayer doing the exchange?
So you would know
Not
that.
the names vested on title,
Right.
the tax reporting.
And so we wouldn't know that from pulling title.
That's
you'd have to see
right.
the taxes as the accommodator, then you get the taxes, or you
No, we don't get the taxes. We're going to ask the
You
question.
ask. Okay.
So what I would
the
recommend that when, for you as the real estate professional, for the investor that's considering selling their investment property, look at your title. See how you're showing, how it's being reported on title, okay? If your title matches how you're reporting it on your tax returns, you're good. If your title is not showing how you're reporting on your tax return, now you've got to get this in sync,
Okay.
all right?
So a good question, even for us early on.
How are
before we
you
submit
reporting it?
How are you?
Yes.
Yeah.
How are
Who
you
is the
reporting?
taxpayer?
Yeah.
How are you reporting?
Now,
it?
here's issues that come up with about vesting. The husband and wife, say for example, or the whoever, they own the property in an LLC that's taxed as a partnership. Now, notice how I said that. I said the LLC is taxed as a partnership because people will tell me, well, I own it in an LLC. Okay, but what is the LLC? Well, it's an LLC. An LLC can be three things.
Okay. Explain.
It can be a single member, disregarded.
Right, okay.
Okay, so where basically I created this LLC for liability protection, but I'm the taxpayer, all right? Or if I'm married, husband and wife, that lives in a community property state, we create an LLC. That too also can be disregarded. Or a multiple member LLC could be treated as a partnership. And then the third potential would be you've elected to have that LLC taxed as a corporation.
Well,
So who's it gets to who's my taxpayer? So in the example of where the tax ownership of the property is in an LLC taxed as a partnership, now the investor wants to go out and they want to buy 1 to 4s.
okay.
They have a loan that they have to replace. So
Right.
there's going to be financing in the transaction. So now, who's going to be the borrower?
That's a good question.
The LLC, because the LLC is the taxpayer doing the exchange.
And that
Here's
is
the
a
problem.
little more challenging getting financing.
There you go.
In LLCs, right?
Right. So you can't go off and get financing in your individual name, take title in your individual names, and close the exchange, and then say later you're going to put it into the partnership. Same taxpayer selling,
Right.
must be the same taxpayer purchasing. So these are things that come up in a 1031. I would like to say that they come up infrequently, but they don't. They come up more often than you think.
So those are things someone should think about of how they're going to take title to something when they buy it in the first place.
Yeah, yes. And on the flip side of that, the exit strategy of how you take title. So say, for example, you get some people that together to buy an apartment building.
Right.
And you create a syndication where you have it as a partnership.
Right.
But now you get ready to sell it. And everybody, so you've got 5 partners. Now the partners go, well, I want to go my separate way. Ben has
Right.
been great, but I just, I want to go off on my own. Well, when you get ready to sell it, who's selling? The partnership, right?
Right.
So Manny, Mo, Jack, Susie, and Bob cannot do an exchange with their partnership interest. So when you talk about entrance, you also want to talk about exit. So if you create something that's like we're talking about right now, like I'm describing a partnership, then in advance of getting ready to put that property on the market, You go to your tax advisor and you determine how are you going to get out of this, so you're in position when you decide to sell it, that you can go your separate ways and not have a negative impact to an exchange.
So if they plan it out in advance, they may be able to change the way they hold title.
Exactly. They would drop it out of the,
yeah,
exactly. They would drop out of the partnership, season the ownership into, because remember that intent?
Yeah, right.
Okay. It's going to come back. It's coming back again.
So intent, they're changing it ahead of time if they want to.
Well in advance, hopefully. But
So
I
if
would
they
have,
want to exit.
I have to tell you, Ben, most of the time I see it is they're sitting in escrow and closing in 3 days. That's
what I'm
never
afraid
good.
of.
That's
Yeah,
never a good
I did
position
not
to be
think
in.
That would probably go over very
That would
well.
not go over very well at all if you get audited.
Yeah.
Not at all.
Wow. Okay.
So did that answer your question about vesting?
It did, yeah. You're talking about moving parts.
And,
You're just
one more
adding
thing, let
to
me,
it.
trust, because people get
Okay,
caught up
yeah,
on trust.
right.
Because a lot of people do estate planning.
Right.
So they put their property into a revocable living trust. All right, so sometimes when they sell and they're selling in the revocable living trust, those trusts, if it's a living trust, is a disregarded entity. So the taxpayer, say for example, if it's my trust would be me. When I go to buy, if I have to get financing and the lender goes, no, you cannot buy in your trust, I'm still okay because I'm the taxpayer. So I can sell out of my revocable living trust.
Okay.
I can purchase out of into my individual name. Same with the disregarded LLC. I
Okay.
can sell out of the disregarded LLC and I can buy in my individual name, or I can sell as an individual and buy into a disregarded entity. As
Okay.
long, so you just have to make sure that the continuity of the tax ownership is on both sides.
Oh, okay. That makes sense. So, yeah, because trusts are very common.
Very
so-
common.
Okay, so we're going to come back and hear some more from Dino about 1031 exchanges. But for now, we're going to talk about some loans and mortgages with Michelle Malura from Cross Country Mortgage. So, Michelle, welcome. Thanks for coming back to the podcast.
My pleasure. Thanks for having me, Ben.
What do you got for us today?
Well, one of the most common questions I get when clients are considering doing a 1031 exchange or even just first-time investment property buyers is, can I qualify if I don't have a job? I'm retired. I don't work anymore. And these people typically tend to come to their own conclusion that if they don't currently work or if they're retired, that they will not qualify for any financing. And then they believe they have to be all cash buyers.
So they don't even check with you to see if they can. They just assume it's got to be all cash. And those are the properties they're looking at then, because that's the price point it falls in.
Exactly. So if they believe
Okay.
that they're all cash buyers, they're going to be limited to knowing what their net proceeds are from the sale, and they're going to limit their shopping to properties within that price range. But what a lot of people don't realize is when you buy investment properties, we actually have loan programs that don't require income or employment from the borrower.
Interesting. Okay. What are some of the specifics on those programs or ways they qualify? How does that work?
Yeah, so what the banks do is they look at the cash flow of the property. So as long as you're putting a large enough down payment where the income generated from the property will cover the expenses of carrying that property, which include the mortgage, property taxes, and any fire insurance policy you need to carry for that property, they will qualify you for financing to purchase that building.
Wow. Oh, that's really interesting. So do you have many people that take advantage of that, or not enough people know about it? We just need to spread the word?
No, we definitely need to spread the word. I worry more about the people that don't call and ask the question.
Right.
The people that call me and ask me the question, I'm able to educate them and inform them. And then it opens up more purchase power for them. And they
Right.
can look at buildings that maybe they like better, have better cash flow,
Right. Yeah.
are in locations that they prefer, better proximity to where they live,
Right.
or
More units, better location. Yeah.
better tenant quality, whatever the case may be. So it's great. The people that come and ask the questions, we're able to educate them. But I worry about all the people that make that conclusion and don't
Right.
ever check their, the conclusion they've made. So I do want to spread the word and let
Yeah.
everyone know.
Well, good. Well, we're talking to a 1031 audience, so that's a good start, and
Yeah.
we'll get it out even more. So thanks a lot for telling us about that. And now we'll get back to Dino. Be sure to reach out if you have any lending mortgage questions. Reach out to Michelle Malura with Cross Country Mortgage for residential or investment property. All right, now back to Dino and more 1031. All right, so you've answered a lot of my other questions as well. Something I've heard, why do you have to replace the debt? What is that?
You know, that's a very, very common question. They go, I don't understand. It's not my money. Well, when you think about what is a loan is money. It just belongs to somebody else.
Right.
So that's why you have to replace it.
Okay.
If you and I were in the same transaction where you were selling something for $1 million and you had $700,000 of debt at the time that you sold, and I had $1 million property and mine was free and clear, from the rationale of why do I have to replace the debt and thinking of the 1031, under that rationale of not having to replace the debt because you only got $300,000 in cash,
Right.
then I have to spend $1 million and you only have to spend $300,000. Debt is cash,
right.
and that's why you have to replace it.
Okay, that makes sense. Another one, and these are questions, you know, our advisors in the office here have gotten either from themselves or from their clients, so there's some good ones. Can I be, or can the seller be reimbursed for the repairs they made selling the property?
Yeah, that comes up a lot. Yeah, and that's a very common question, especially when people get their properties ready for sale. So what happens is you start now, you had a property, maybe you had a tenant in there for 15 years. Now you have to replace the carpeting, you have to do the painting, you know, all of this stuff. So that's an outlay of cash that you're going to be spending to get the property ready for sale. So sometimes that bill can be pretty steep, you know, $30,000, $40,000.
Definitely.
So people go, well, I want, you know, and I've heard people go, I've got it on my credit card, so I really need to pay this credit card debt back. I understand it. What's credit card interest rates? 20% or some ridiculous number? Yeah. All right. So when they want to get reimbursed, they can take the $30,000 or $40,000 at the closing, but, and this is the key, that is going to be subject to tax.
Oh, really?
Yes. Now, could their tax advisor find some way to mitigate that? That's going to happen in the back end. But, you know, you're not getting any money you keep out of the exchange is going to be taxed. It's up to the accountant to determine what that's going to look like at the end. Some of those items that you're doing to getting the property ready can be considered a capitalized cost. So that's not an expense, that's adding to the basis in the property.
Okay.
Repairs are something that you write off. So that's up to the accountant to determine how they're going to look at those numbers and whether they can mitigate any of that.
Okay.
So
Good.
just be prepared that when you're doing, you know, getting a property ready, that if you're going to want to be reimbursed, just know that those funds are going to be subject to tax.
Okay. Good. Well, fixing up the property, you know, should get them more money on the sale, so
Should.
kind of offsets a little of that tax. Maybe.
Yeah.
Something I hear a lot about is boot.
Boot. Okay. Yeah, boot actually is the 1031 term for taxable.
Okay.
That's really all that means. So boot means that portion of the transaction was not used to buy new replacement property. So there's typically two types of boot. There's mortgage boot, which means you did not replace the debt. So that tells me you bought less than what you sold for.
Okay.
Okay, and then there's cash boot, which is pretty straightforward. You didn't spend all of the cash.
Right.
So that portion is going to be subject to.
So another thing is, you know, what tips would you recommend to investors considering an exchange going into it? We talked about the basics now.
Yeah.
Going into it, some of the tips.
Yeah, good question. To me, one of the biggest tips is make sure that before you do anything, you're consulting your tax advisor. Yeah. All right, you're going to consult your tax advisor because, first of all, you want to determine, based on your tax situation, do you need to do an exchange? Some people may, you know, there may be some gain on the sale of that property, but because of other things going on their tax returns, they may have lost carry forwards or something that can mitigate any tax liability.
Okay. Right.
So you may not need to do an exchange based on that. You also want to have your tax advisor involved in your transaction because that tax advisor can be reviewing the closing statement. See, we as a qualified intermediary, we can't give tax or legal advice,
right.
even though, yeah, exactly, you
You're
as well.
More tied into it a little.
We're tied into a little bit more,
line,
exactly, but we're I mean, if you read all the fine print under my signature on my email, right? It says, we do not give tax or legal advice, right?
Yeah.
By 5,600 million times. So you want to have your tax advisor review the closing statements because maybe there's something on those closing statements maybe you can't fix it, but you at least prepared that you may be having to pay tax on something like that. But you want them to look at your closing statement. We don't know how the accountant's going to review that closing statement and how they're going to basically report the exchange on the return. So to me, you have the tax advisor to look at, to make sure, confirm your vesting and your tax reporting. Find out, you talk to them whether you need to do an exchange or not, and then to review those closing statements both on the sale and both on the sale and the purchase. The next thing is you want to talk to a qualified intermediary. When they're going to be talking to you to get about listing the property, right?
Right.
Okay, they're going to talk to me about what to expect in an exchange. So I'm going to have a conversation with them just like I'm having with you right now.
Right.
This is what the 1031 is. These are the rules. These are the time frames. This should be your target purchase price. I'm going to explain everything that's going to go on, explain what to expect going forward, how all the details and everything work.
Okay.
Or
we'll just have them watch this.
There you go.
We'll save you a few conversations.
Yeah, you can have popcorn and drink wine, or beer, whatever's your
Even
preference.
better. They don't do that with you?
They maybe, I don't know. And so just to go over the time frame, so talk to the qualified intermediary. Take ownership of your transaction, because sometimes people go, well, I leave it to my professionals to do everything. Right. But each professional you have in this transaction has their specific role. Escrow has their role. You have your role as a real estate professional. I have my role as a qualified intermediary. The lender has their role as the guy or gal providing the financing. The accountant has their role. And so we're not always all talking to each other.
Yeah.
Okay? But the one common denominator we have is who? The party doing the exchange, right? So take action, be proactive, okay? Because you're electing, when you're selling an investment property, you're electing to do a 1031. You're electing to do a tax transaction. Yeah. So stay engaged, communicate, be proactive, know your time frames, know how much you have to spend. And when in doubt, ask questions. To the professionals that you're working with, in that transaction. Not your neighbor, unless your neighbor happens to be your qualified intermediary, okay? But you want to go to the parties that are doing the transaction. So, ask the questions, because sometimes there are things in a 1031 that may be fixable, and there are things that are not.
Right.
And, you don't want to find out that you're in the things that are not part.
Right.
So, talk to your tax advisor on, do you need to do an exchange? Check your vesting, have them look at the closing statements. Understand the timelines and the requirements for a 1031. At least familiarize yourself so you understand when we're speaking this language to you.
Right.
It's more, it makes more sense to you. And then again, be proactive. Right. Be proactive.
It's always a good idea.
Yeah.
Be proactive in most things you're doing, especially when it comes to real estate.
Yeah, but a lot of folks are not.
Right.
Yeah, they're not. They leave it to the other professionals to be picking up the ball, and then when that doesn't always work out well.
Right.
So.
Yeah. Okay, so tell me about a reverse exchange. I've had that come up.
Okay.
I know we've heard that.
Excellent. Yeah, so a reverse exchange actually is a part of the 1031, and the reason it's called a reverse exchange is because you're doing it in reverse. You're closing on the purchase before you closed on the sale. The technical term for what it is called a parking arrangement, because what happens in that transaction, the taxpayer cannot be on title to both properties at the same time. So they can't just go off and buy the property, even if they've had the means to do it, be on title to the property, and then later sell their property and say, okay, my replacement property is already here, I'm good. Okay. You can't, because you already own it. So in a reverse, we as a qualified intermediary, we are going to create an LLC where we physically, we're the member of the LLC, where we physically go on title to the property that they're purchasing, so that the taxpayer is not on title to both properties. Now, when you talk about a reverse exchange, remember, nothing has sold yet. They're just buying. So the big question comes up in a reverse transaction is, where are you getting the funds to buy the new property?
Right.
Because nothing is sold. So if somebody tells me they have all cash to buy the property, that makes it a lot easier. Doesn't make it less complex, but it just makes it easier because there's no financing involved. Yeah. So what happens is, we'll just keep it the easy way right now. So the investor will create the LLC. we have to become the buyer of the property.
Okay.
The party that's doing the exchange is going to basically bring in the money. They're going to bring in the money to escrow. They don't necessarily bring it into us. All right. When the purchase closes, our LLC is on title to the property.
Okay.
The time frame for a reverse is the exact same as the time frame for a forward. So you have to get your relinquished property identified, the one you're going to sell, within 45 days, and you have to complete the 1031 by the 180th day.
Okay.
All right? Generally not a problem.
Yeah, it seems a little easier going that way.
It is. I've had one situation where when I say we got down to the 11th and a half hour, I sincerely mean it. Okay, yes, there was a lot of delays on closing the relinquished property, and escrow barely got it done the same day that we had to be off title to that property. Okay, so what happens is, so we go on title, starts the clock for the exchange. Then you get the relinquished property under contract. So now you open up escrow. There's going to be there's a set of documents that come in for the reverse exchange. There's going to be a whole different set of documents that are going to come in for the forward exchange, because now it's coming into the regular exchange itself. So let me just pivot for a second and go back to the type of documents, what's going to happen on the reverse. We're going to create the LLC. We're going to create a master lease, so basically a triple net lease. Okay, because we're not going to manage the property. We're just merely there, ergo, parking title. We're parking title. We're going to create a promissory note.
Okay.
Because why? You gave me the money, in essence, to go buy the property.
Right.
So we have a note, right? So then when you go and sell your property, now we're going to create, and you get an escrow, we're going to create the other exchange documents, because now this is when the exchange is going to take place.
Right. Okay.
The buyer brings in their funds. The escrow now wires the funds to us at the closing, like any forward exchange would, right?
Mm-hmm.
Now we have that, say they wired that $1 million in. We're now going to pay you back your $1 million.
Right. Okay.
And we're going to come off title to the property, and you're going to go on title to the property.
And there it is.
Now, not everybody has all cash.
No,
If there's going to be financing involved, if you're going to a typical lender, it's going to be almost impossible to get this done.
Right. I
So
can imagine.
when we talk about reverse exchanges, people have heard about them. Before you start, rushing to that conclusion that you're going to do one, you need to make sure that you can do one. Yeah. They're available, but I will tell you probably 80% of them are not doable because people cannot get the financing or don't have the means to do it, to buy the property. And I will say they're definitely a more expensive exchange.
Oh, yeah.
Yeah.
No, the convenience.
Yeah, well, you have to look at the
Price
economics
for
of it.
convenience, right?
You have to look at the economics without question. So
yeah, and they need to just not know the concept, but actually go talk to all the players in that process to see, is this even doable?
Exactly, because you don't want to find yourself getting in a contract that you're obligated to close on, and now you can't do this in a reverse fashion. So
Well, that's good.
Yep.
Okay. Well, again, thank you very much.
My pleasure.
Incredible information as always. We appreciate you taking the time and
My
coming
pleasure.
in and going through some of this. I know it's second nature to you, but it's not to a lot of people. So
Understood.
That's a lot of really good information. So, all right. Now, if you have any questions about 1031s, definitely reach out to Dino Champagne, Asset Preservation. Her contact information is going to be here on the screen. If you got this information from one of your EV advisors or wherever you found it, definitely let us know to keep the information coming. If you enjoyed it, subscribe, like, do all the good things you can do with social media, and make sure you see these when we release the next episode. All right. Thanks, everybody.